This video is all about guiding you as you go down the road of basically building your dream. You want a piece of property, might be 5 acres, might be 500 acres, but the whole goal is to have that piece of property removed from other people, removed from city life, and to build something on it. Whether that's rebuild a farmhouse that was on there, build a custom home, build a barndominium, maybe even just a weekend getaway, but you're going to be using financing for at least a part of it. So that's what this video is about. I'm talking to a guy who does about 95% of his business as a lender, lending on raw land and on construction of some type of buildings on that property. So grab a pencil, piece of paper, maybe a cold drink, and listen in as we go down this road talking about what does it look like to start the financing process on a piece of property that you're going to build something on. Where do you start on, hey, babe, I want to build a house on some land. I want to get out of Austin. I want to get out of Dallas. What's the first step? What do we do?
Well, first thing, you decide where you're going to be.
Okay.
Right? All right, we decided we're going to be between Dripping Springs and Wimberley, Blanco, somewhere in that area.
Okay.
Right. Before you get too far, I'd say, into what you're going to build, what you want to build, you're going to want to find that lot. And by lot, I'm talking about anything from a half acre up to maybe 20 acres. Right. And at that point, typically you're going to buy the lot, whether you finance that or buy that in cash. And as we get further in the videos, Chris, I'll explain some of the things of how you could actually buy a lot and have that loan rolled into and be part of the construction loan as well. But let's go through kind of the most standard, the most basic. So we're gonna assume right now, as we talk construction, you found your lot, you bought your lot, or you financed your lot. Anyway, at that point, the lot is yours.
Right.
You're then going to start thinking, all right, this is what we're going to build. You're going to come up with your kind of dream plan. Now, I'd say as soon as you know you're going to build, even if it's 6 months, a year out, now's the right time to come to Trey and let's start talking about it.
Now, this is a good time to remind you that if you are buying a piece of property, these conversations with somebody like Trey are probably going to start a lot earlier if you're looking to finance the land also. Now, that wouldn't apply if you're going to buy the land cash or if you already have that land. But one little thing on buying it cash, if that's your plan, that may not be the best use of your money in this process. So again, I would highly, highly encourage you to start this process with somebody that you trust early, even before you buy the land, to see, hey, does it make sense to buy cash up front, or would it make sense to buy the land with a loan and the construction financing with a loan and then roll it all into permanent financing at the end? But let's get back to this conversation now.
Finance, right? Because it very likely is going to have a lot to do with the size of the home you build, maybe who builds it. We need to know whether you qualify to build a home for 400,000 or 1.5 million.
Right.
Right. And where does that fit into really what your dream
and your
is
budget and what your dream
your budget and what you want? You always, it's the same as a purchase, right? Before you go look for a house, you kind of need to know what you're going to qualify for.
Right.
Right. So that's kind of the step. On my side, when it truly is ready to go with the construction loan, I need 3 things. Okay. Now, this is after we've qualified and we know you're qualified. Well, and we'll get into that. You want to get into that?
Well, I was going to say, let's back up a little bit before we get into what you need. What's a construction loan?
Okay, what construction loan, when we talk about mortgage type loans, there's a couple of different types. You think about a purchase or a refinance, you're talking about we're buying this or we're refinancing this. You're getting one big shot of money. Right. This is it. This buys your house. And you're going to then be paying on that loan for some period of time, 15 years, 20 years, 30 years. Right, your permanent loan. Construction loan, very different. It's a temporary loan. It's only going to last during the construction period from when you start and when the home is complete.
And that the typical initial period is usually a year, right?
You know what? That's kind of a good average.
Okay.
I know some home builders, even out here, depending on if they have their own subs or whatnot, might get a true custom home built in 6 or 8 months. Okay. And there's some, due to sheer size, could be a year and a half.
Okay.
That's the reality of the way it is. So this is a temporary loan. We're just trying to get you from the beginning into a completed house, right? At which point at the end, you are going to go into that permanent 30-year fixed,
traditional,
like every other traditional mortgage you've heard of, regardless of it's a a conforming loan, smaller, or whether it's a very large jumbo, which typically that's what we're getting into if you build a custom home.
Yeah. And
Here,
especially out in
right?
this area.
So
Yeah.
again, when I say it's a temporary loan, it is not a lump sum loan. It is a line of credit.
Okay.
Right. So
That makes sense.
we've qualified you, Joe Q, home buyer. You qualified, let's say $1 million, right?
Yep.
It's this market these days,
That can
build a
happen in a
custom
hurry.
home,
Yep.
and that's about where you are. So let's say the whole project is $1 million to build, right?
After dirt, we're going from dirt to keys.
Whatever. That's what you need to borrow.
Right.
Let's say that you're going to borrow. So you then get a construction loan, the line of credit for $1 million for the time periods, and when you get it till it's completed, it's an interest only loan, right? You're not paying any of the principal down because you've not been given principal. It's still that line of credit, right? So the way it works is your builder and me are working together primarily on all the money side once you get qualified and we close that loan. Because as they finish different stages of construction, they're going to make a draw with me.
Right.
Right.
So the homeowner's not having to pay. You're taking care.
You're not paying along the way at all.
You could if you're gonna put this thing out of pocket cash, you can do that.
You could.
But if you didn't want to,
and I'll mention, and let's remember to come back to this, Chris.
Okay.
On if you put an infusion of cash from the very beginning into that loan when you close.
Okay.
How that works and how advantageous that is with interest payments alone.
Yeah.
Right. So let's say, boom, pretty standard. The first really big expense, the forms go up. They're going to pour the foundation.
Right.
I don't know. Let's say on that house, 80,000, 100, 150. As soon as that foundation is poured, your builder is going to make a draw request with the bank, right? And the borrower, you, the homeowner, are always going to sign off on that on that draw request. It's kind of checks and balances all along the way. When we get that draw request, typically we've got a 24-hour turnaround. That builder is then getting
paid up to that point.
Right. So almost in every scenario
Okay, I'm going to jump in here real quick just to point out something that we skipped over. Once you've taken out all of those draws and the home or the barndominium or the weekend getaway, whatever you're financing, is complete, before you move in, typically you're going to have to refinance that into permanent financing before you do that. I mean, I know people who have they failed their certificate of occupancies because they started moving in furniture and the county wouldn't give them their certificate of occupancy and the bank wouldn't sign off on that permanent financing because they didn't have a certificate of occupancy. Now, that's normally the way that I see it done. It could be different in your state. So again, you're going to have to talk with your lender and figure that out, what that transfer looks like from that construction loan into that permanent financing. But just wanted to jump in real quick and point that out. Let's keep the conversation going here.
Pretty decent sized, reputable custom home builder, they're floating the project along the way. They're not asking you, hey, we need that $150,000.
I'm about to start the slab. I need that 150 up front. They're paying for that, and then you're or the bank is reimbursed.
That's right. Typically, the builder is going to be floating that, knowing they're not on the hook for a long time. And the builder has a line of credit with the bank that they work with all the time as well. So anyway, that draw request gets put in. We process that, and boom, the builder gets their check, and they just continue on. And that's the same all through the process. Typically, whether a certain builder wants to do it by a 30-day draw period or they want to do it by large stages of completion process.
Slab framing,
right? When it gets framed, we know a draw's coming.
Right.
Right. And then when you get to the middle, you've got a lot of things going on at the same time. It's going to be a draw request for the electrician, the HVAC, and the plumber.
Yeah.
Generally all at one time on that one. And so we're just going through that process all along the way, right? Until the home is complete. But let's talk about just a second about how your payment works on that loan.
Okay.
As you go through.
Yeah, because you said interest only.
Again, it's interest only. So the very first payment that you make that first month, if there hadn't been a draw made, there's no payment, right? Let's say let me hang
on for 1 second there, because it's something I don't remember when we did ours. you don't have a payment that first month, but do you typically have closing costs when you close that loan, or are those rolled into that
No, you
construction?
will have closing
Okay,
costs.
so you're going to
Yes.
have to take care of
Yes.
closing costs up
Yes.
front. Okay.
That's right.
Okay.
And it'll depend on what type of construction loan you're closing,
Okay.
which we'll get into in a lot more
Yeah.
detail. I know on a later one. Don't want to do that right now at this point. But let's just stay on a standard build. We get that after 30 days. We get that first draw request for the foundation.
Mm-hmm.
We turn it around. That next month, it's 30 days after the day you close that loan is when your payments are going to be due. You're going to be paying interest specifically on that amount that was drawn.
So if it was $100,000 for the slab, you're only making
that.
interest on 100,000.
That's correct.
Okay.
And then the next month, the framing went up. You got another $80,000, right? So now you have drawn on that loan $180,000. Month two payment on interest only is going to be on that 180. And as the different stages are completed and different draws are made, it's just going to stair step its way up, right? Your payment in the very beginning is quite low. And at the end, it's what you would be expecting if you ran the interest rate times the entire loan as when it's drawn out.
Gotcha.
Right? Stair steps up.
And I want to make sure people know this from the very beginning. You've got a construction loan product. You're not looking at an interest rate like a 30-year fixed conventional, 20% down loan. That interest rate is going to carry a premium on it.
Typically it does. Now, that doesn't mean so this is just a moment in time, and I would imagine the video is going to be continued to be viewed for years, right? But just to give an idea, right now in the market that we're at, interest rates,
July
as hard as it is, are right about, call it 7%.
Okay.
Right. So a construction loan interest rate is going to be a little bit higher than that. Say a good range would be at half to 3/4.
Okay.
To what you're seeing from a prevailing rate. So
just
like
a little
at
bit
this
of
point,
premium. Yeah.
7.5, 7.75 would be about what we'd be expecting. But again,
he's not guaranteeing you a rate.
This is not
in 2028.
This is not a rate quote in any way. Your rate is going to be determined by the details of your loan, your loan to value ratio, your credit score, all these.
Now your attorneys are happy. Right. There you go.
Yes, right. MLS number. Little fine writing.
That's right.
Yeah.
So anyway, there you go. So you've got that your payments step up as you go.
That's right.
And we're on an active construction site if you didn't know. So anyway,
good music in the back.
That's right. That's right.
So also, I guess at some point that ends.
Right.
And when the construction loan is done, when it's fully drawn, when you're complete with the house, I'm going to tell you on kind of a standard 2-time close, it's then almost as if you already own your home, you have a mortgage on it, you're required to refinance that mortgage. At that point, you're going to be going through the same refinance process you would have, or you've probably gone through at some previous time in your house. It's very straightforward, simple refinance. That puts you from the interest-only loan into that permanent, say, 30-year fixed loan. Or it might be adjustable. Yeah. Whatever you choose is best for your case.
Pop it in one more time real quick. Something that's jumping out at me is this whole process isn't just about getting approved for your construction loan. That's the first part. But going through this process, really, you're going to have to pay attention to managing draw schedules, managing your builder. I know you're hiring a general contractor to do this, but you're still going to have to manage them. You're going to have to manage expectations of yourself, of your family. You're going to have to manage inspections, county inspections, maybe city inspections, maybe state inspections. All of these things are what you as an owner, or if you have, again, another team member, maybe it's a realtor, maybe it's a member of your family that's done this, but somebody's going to have to help you manage all of these things along the way. So it's not just about getting pre-approved for a construction loan and then here we go, we're going to get it built. Make sure that you're managing all these other parts of it along the way, because if you're not, I mean, I've seen it over and over where a dream house just becomes an absolute nightmare, and a 1-year build process ended up taking 2.5 years, and everybody's mad at everybody. You've got to manage all these things along the way and realize this is going to take active input from you as a homeowner, or else it could potentially blow up in a bad way.